A very good morning, friends. I hope you're all doing well. And I think most importantly, your cumulative revision on Index 103 is going on. So just to remind you, we are working on the 7-step model on acquisition accounting. And out of that, we are on step number 4. That is one of the most crucial steps on acquisition accounting. And that is the calculation of the purchase consideration, or you can technically call it as a consideration transferred. In the previous session, that is yesterday, we had a deep discussion with reference to various components of a purchase consideration, where I discussed the concept of a DC, a deferred consideration, that you consider that at a fair value. Then we also had a discussion with reference to the CC, which is a contingent consideration, which is either paid in the capacity of the shareholder, or there is a contingent consideration which is paid in the capacity of the employee. Now, if the contingent consideration is paid in the capacity of the shareholder, of course, it is taken as a part of the purchase consideration, and of course, at a fair value, which would, of course, be given in the question. But if it is a contingent consideration which is paid in the capacity of the employee, then it's not considered as a part of the purchase consideration. And I also gave you a chart, where we saw that once you initially account for these components, what is the subsequent accounting treatment as well? Like in DC, it gives rise to unwinding of discount. In terms of CC, in the shareholder's capacity, you need to watch out whether the form of consideration is cash or equity shares, and accordingly, you would conclude based on Index 32 parameters, whether it's a financial liability or equity instrument, and accordingly, a remeasurement of a financial liability would take place, but not for an equity instrument. Then I also gave you that in case you're looking at a contingent consideration in the employee capacity, then Index 102 is applicable. So there was a 3-step model which we understood in terms of DC, CCS, and a CCE. How do you identify that which of the components we're talking of? Then I gave you the inputs on a transaction cost. That is simply a revenue expenditure. It is not considered as a part of the purchase consideration, taken to the profit and loss directly. Then we came to the 5th component, and that was a crucial point again, and that was PHI, that is a previously held interest. We also called it as a step acquisition, wherein we saw 2 combinations. One is a conversion from a passive investor to control, that is moving from Index 109 to the concept of control. And we also saw the concept of a significant influence turning to control. That is a movement from Index 28 equity method to a situation of control. And we saw what entries do we need to pass. Typically, you need to revalue the investments, and the fair value changes will enter the P&L, OCI, as the cases might be. And typically for an equity method, we also decided that the amount in the OCI has to be evaluated whether it relates to R or NR, and accordingly you put that amount in the retained earnings or directly or rooted in the P&L. And then I came to the next component, that is the 6th component of the purchase consideration, which we're yet discussing, and that is a share-based payments. And for which, of course, I gave you a brief input that when you're looking at a share-based payments, in those particular cases, we're looking at 3 kinds of combination. One is a case where there is a mandatory replacement by the acquirer. One is a case where he refuses to replace, and one is a case of an option replacement. I give you the logic as well that why in terms of a share-based payments, why would the acquirer company be keenly interested in giving the shares to the employees of the acquiring company? Because he knows that the ESOPs which have been given to the employees of the acquiring company would actually reduce his control in the future years to come. So he could be keenly interested in making a replacement of those particular shares, because once he gives the own shares to the employees, at least he retains a control of the company. So that was a quick review in terms of things, just the basic thought process. I thought before we start in detail the discussion of share-based payments. Okay, so let's, I think, begin. Let me also see if any questions are there. The warm-up exercise is done. Then I think we can go forward. Good morning, Viraj. Good morning, Namrata. Good morning to all of you. So I think let's begin the journey. So we are now going to work upon back to the step number 4, that is purchase consideration. Out of the main steps, we're looking at step number 4, that is the purchase consideration. And I'm looking at one of the components, that is share-based payments, which is my issue number 6, the special issue number 6 within the purchase consideration. So let me make a mention that this is my special issue number 6. And let me also remind you that, this was also one of the exceptions in terms of the step number 3B. So this relates also, you can say, to the step number 3B as well. Because when you're looking at the exceptions, as far as the list of net asset is concerned, this was one of the pending items. And there is another pending item, reacquired rights, which we're going to talk in the pre-existing relationship. Okay, now let's get the focus very clear. As I said, that if I'm looking in terms of share-based payments, there are basically 3 permutation combinations which could arise. Number 1, it could be a case of mandatory replacement. So one is a situation where there is a mandatory replacement. The second situation is that it is a case of optional replacement. The acquirer decides, okay, I'll replace, though it is not mandatory on his part. Or the third situation is he decides not to replace, so there is no replacement. Now, we need to first of all understand one very basic concept so that there is no confusion later. So before I fill up this chart, I'm just going to give you one basic input. Let's go to the acquisition accounting entry and let's understand one thing very clear. So I'm coming back to the step number 7, which is my main focus, that is the acquisition entry. So I'm coming back to the focus on step number 7, that is the acquisition entry. Now, we need to appreciate one thing. The entry which I am talking of is from the perspective of consolidation. When you're looking at the consolidation entry, you've got the financial statements of the acquirer. And if you insert the acquisition entry within the balance sheet of the acquirer, you're going to get a consolidated balance sheet. Nobody, if this was not very clear, nobody will be coming back to the picture once again. But let's, I think, look at the acquisition entry. Now, in the acquisition entry, what do? We record the net assets and they are recorded at a fair value. And we record the purchase consideration. And this is what we're computing in terms of step number 4. And if there is an NCI, this is also taken, which we're going to compute in terms of step number 5. And then we get a balancing figure as a goodwill. And this, though, will be computed in terms of step number 6. So this is what you've already taken in terms of step number 3. So this is the basic focus. I'm just reminding you back. So when you're looking at the acquisition entry, this is the acquisition entry. Now we need to understand one very important input. If the acquirer company is going to replace the share-based payments, that means he needs to create an SBP reserve. Now remember, when you were looking at Ind AS 102, when you were looking at the entry with reference to Ind AS 102, I'm just going out of the standard and looking at an entry, what we used to do in terms of Ind AS 102 when equity settlements were done. So what the company used to do, put an entry employee benefit expense, and correspondingly, we used to give a credit to SBP reserve. This is the entry which is done in terms of Ind AS 102. So let's keep 2 things in mind very clear. One is the entry which we do in terms of Ind AS 102 when there is a accounting for equity settlement. I'm looking at that this is the accounting which we do in terms of equity settlement. So when there is an entry for equity settlement, basically you need to give a credit in the books of accounts, which is called an SBP reserve. Now, if the acquirer company is making a mandatory replacement, I guess what we need to do, we need to insert in this entry that SBP reserve. Because if he says that I'm going to replace these awards, then he needs to put in his books of accounts the SBP reserve. Now, there are two alternative ways of doing that. So just see this very carefully because there should not be any confusion later. So there are two alternative ways of doing that. So let me give you the two alternative techniques which you can adopt. The first alternative is if you want to incorporate this SBP reserve. Now, what is the amount at which it will be incorporated? We're going to discuss that later. But there are two alternative techniques of incorporating this SBP reserve. One is you add this amount to the purchase consideration. So one of the ways is that you increase the amount of purchase consideration to the extent of the SBP reserve. And then you pass another entry, and that is purchase consideration will be given a debit and SBP reserve is going to be given a credit. So this is the entry which you can pass in this particular case. So this is one way that you first of all incorporate this SBP reserve. And when you incorporate this as a part of the purchase consideration, I'm not taking it as a part of the net assets. I'm not taking it as a part of the step number 3B. So get this very clear, that in the first alternative, I'm not considering this as a part of the list of the net asset. And I'm just adding this as a part of the PC, and then you segregate the SBP reserve separately, put an entry, and it's just, PC debit and SBP reserve credit. The second alternative, which you can do, the second alternative which can be done is, let's not put it in the PC, so let's not take it in the purchase consideration, but you do one thing, you give a separate credit to the SBP reserve in this entry itself. And then there is no need to pass the second entry. I mean, the logical effect is same. But sometimes people tend to get confused, sir, is this going to be added in the PC or not? It's your choice. You can follow any of the two alternatives, whichever seems convenient to you. I would suggest it is more appropriate to include it in the PC. You get a control factor that, yes, I need to actually, take care of this. So I would prefer, but I'm not saying that this is the correct alternative. I would prefer that you should always add the amount of SBP reserve to the purchase consideration and then put a separate entry in this particular case. Secondly, alternative is that you incorporate this as a separate item in the acquisition entry, so which indirectly means that you have taken it as a part of the list of net assets. So you got a free choice altogether. So let me just consolidate the picture. That when you are looking at a question and there is a talk about share-based payments in the question, and you see that in terms of share-based payments, I'm talking of only mandatory replacements right now. I'm not talking in terms of optional or no replacements right now. So this discussion which I'm doing is in terms of that there is a mandatory replacement in terms of things. So when there is going to be a mandatory replacement, you've got two alternative techniques in terms of incorporating this. Add it to the PC and put a separate entry, PC debit, SBP reserve gets a credit, or in the acquisition entry, put that SBP reserve directly. Because since it's a mandatory replacement, the acquirer company needs to incorporate this SBP reserve as a part of the acquisition accounting entry. I hope I am pretty clear till this particular stage, right? Okay, so now let's take it further. We've understood that this SBP reserve is going to be incorporated in the entry either by way of adding it to the PC and then putting a separate entry or directly incorporating in the entry. But now the crucial point is at what amount are you going to record this? So let's come back to the chart. Now, in order to understand what is the amount which we're going to include in the SBP reserve, we need to appreciate one thing. And that is, let's take an example to understand this. So let's consider that the vesting period originally, the original vesting period which was given to the employees of the acquiring company is, let's say, 5 years. Let's take a very basic example to understand. So let's say the vesting period, which was originally announced by the acquiring company, is, let's say, 5 years. And let's say out of these 5 years, there is already some period which is elapsed. So let's consider that 2 years has already elapsed, and what is yet to elapse is supposed to be another 3 years. So now we need to understand that what the acquirer company would incorporate in the acquisition entry is not the entire amount, but it is only the component which is already passed by. So which means that we can indirectly say that there is a certain proportion. We can say what is elapsed is a pre-business combination, and what is yet to elapse is the post-business combination. So we need to very carefully understand that when you are going to incorporate that SBP reserve in the books of the acquirer, you don't need to record the entire amount for 5 years, because pre-business combination period, you can say only a period of 2 years have elapsed. So yes, a period of 2 years is elapsed. So we need to segregate what is the portion which relates to the pre-business combination period. Only the pre-business combination period component is to be inserted in the acquisition entry. And the remaining 3 years is got to be inserted and accounted as a post-business combination accounting. So one thing you need to be very careful on, that the amount of SBP reserve to be incorporated in the entry is only to the extent of the period which is already lapsed, the period which is, you can say, already vested. So in this particular case, I'll give you a simple 3-step model to apply this process. So I would say that to go very safe, let's go with a 3-step model, how you are going to calculate the component to be included in the acquisition entry. So we're going to apply a simple 3-step model so that we don't go wrong. At the first step, what you need to do, you just need to organize the fair value of both the awards, the original award as well as the replaced award. The original award is what the acquiring company gave to the employees of the acquiring, and the replaced award is what the acquirer wants to give it to people. This data will be given to you in the question very carefully. So all you need to do is just organize that what is the fair value on the date of acquisition. Mind you, this is the fair value on the date of acquisition for both the original awards and the replacement awards. That data will be directly given in the question. Just organize that. Simple. Then in step number 2, we're going to calculate what relates to the pre-business combination. So what we're going to do, we will take the fair value of original awards, what you've already calculated in step number 1. So we're going to consider the fair value of the original awards, and we need to take a proportion of this. And we need to take a proportion of this, and this is interesting. I will give you the logic also, but just see what is the proportion to be taken. In a very idealistic situation, in this example, it is 2/5. If you look at my example, out of the 5 years, 2 years is pre and 3 years is post. So basically the proportion for pre-business combination is 2/5. But what the standard setter said, that you need to consider the vesting period which is already completed. In my example, of course, it is 2 years. And you need to consider the original or the total vesting period, whichever is greater. So we didn't understand that. No worry, I'm yet to explain. So you need to consider a proportion which is vesting period completed upon original or total vesting period, whichever is greater. Now I'll tell you some story. You know, what was happening in the industry was something very interesting. What the companies were doing in a practical life was very interesting. You know, imagine that the acquirer company tells the employees of the acquiree that during the course of acquisition, I will replace the awards. The employees may not be very comfortable, you know, taking the awards of the acquirer company. They've already been associated with the acquiring company, so they may not be interested in taking the new awards actually. So in order to induce them, you know, what the acquirer company used to do, they used to say that we will replace the awards and reduce your vesting period to a total of 4 years. So in order to induce them, so what they used to do, they used to tell them that, okay, we're going to reduce the vesting period. The vesting period was 5 years. You worked for 2 years. You got to work for another 3 years. No problem. Now you need to work only for another 2 years. So the acquirer company used to actually reduce the vesting period. Now, one would say, so what's the big problem? If you're going to reduce the vesting period, then, okay, he needs to work for another 2 years. But then the problem arises that when I take a proportion, do I take the original in the denominator, which is 5, or do we take a total vesting period, which is 2 plus 2, that is what is elapsed and what is yet to elapse, which is the new vesting period, that is 4. So original is 5 and now the total vesting period is supposed to be 4. The standard set has said that you got to consider the greater of the two. And in this particular case, there were a lot of other considerations also which was decided, but I'll tell you something very interesting. Now watch this. If you consider that I am considering 2 by 5, it comes to 40%. And if I consider it is 3 by 5, then in this, if I consider not 3 by 5, so if I consider in this case 2 by 4, then it comes to a total of 50%. It comes to a 50%. Now watch this carefully. You may not get the logic immediately, but just see this very carefully, what the standard set has thought. Now, before I come back to this, let me just come to the third one. As far as the post-business combination is concerned, we're going to consider the fair value of the replaced awards, which you've already calculated in step number 1. So we will take the fair value of the replace awards minus what you've computed in step number 2. Minus what you've computed in step number 2 that relates to the post-business combination. Now, if you want to get the logic, hear me very carefully for the next few minutes. You will get the logic. So now hear me well. So this is a 3-step model in terms of deciding what relates to the pre-business combination, which is a part of the acquisition accounting entry. And this is a post-business combination, which is going to be accounted as per Ind AS 102. This is the post-business combination portion, which is going to be accounted under Ind AS 102. Now, hear this carefully. The standard setters realized one very important aspect, that when the acquirer company was reducing the vesting period, they not only had the intention of inducing the employee to go for replacement, but they had some malified intentions as well. Hear me very well. Hear the words very carefully. The standard setters actually realized that when you reduce the vesting period from 5 to 4 years, one of the objectives is to induce the employee that, okay, you take the new awards from me. But there was another malified intentions of the acquirer as well, and see what is the malified intention. If you consider the proportion in the pre-business combination as 2 by 5, 40% enters in the calculation of my journal entry, acquisition entry. So you can say 40% component enters the acquisition entry. So when you go to apply the step number 3, can I say the balancing figure is going to be greater? Because from the fair value of the replace awards, you reduce only 40% of the value. So the amount in step number 3 is going to be bigger. And if the amount in step number 3 is going to be bigger, so what will happen when you will account under Ind AS 102, your hit on the profit and loss increases. Because the post-business combination portion is going to be accounted under Ind AS 102, so that hit is going to enter the profit and loss account. So a larger proportion will be accounted in the post-business combination period, and which is going to take a hit on the profit and loss account. Today, when you're taking 40% as a part of the acquisition entry, it doesn't take a hit on the profit and loss, except that it creates a goodwill or a bargain purchase gain in the entry, but there is no hit on the P&L immediately. But then a larger proportion takes a hit because of the post-business combination accounting. On the contrary, if you take the proportion as 2 by 4, the standard setters would have allowed you that, okay, let's take the new vesting period and let's take the proportion as 2 by 4. then you'll end up taking 50% in the step number 2. So when you take 50% in step 2, the amount in step 3 reduces. And if the amount in the step 3 reduces, the hit in the profit and loss in the future period actually goes down. I don't know if you got the position or not. So the standard setters realized that these companies, acquirer companies, were actually working on a big kind of a plan for the future. Because they knew that if you're going to tell them to take the vesting period 2/5, you take 40% in the pre, and then you can say a larger portion goes for the future accounting, and which means a larger portion hits my P&L in the future. And if you tell them that, okay, we'll take things on the new vesting period, then the step 2 takes a 50% hit and a smaller portion hits the step number 3. And if a smaller portion hits a step number 3, the company is bound to take a lesser hit on the profit and loss account. Did I make a sense? So what the standard setter said, that boss, you want to reduce the vesting period, it's your free will. We can't stop you. You want to reduce the vesting period, you can, but we can tell you one thing, that we will allow a proportion which is vesting period completed upon original, which is 5 in my example, or total, which is 4 in my example, whichever is greater. So if you reduce the vesting period, I ignore it practically. You increase the vesting period, I'm more than happy. And no acquirer company would actually increase the vesting period. Employees would not even take that. If you tell them that now I give you new awards and I enhance the vesting period to 6 years, the employees will say, why should we take these awards in this case? They may not agree to the arrangement. So the only possibility, practical possibility we see is that there is a reduction in the vesting period. And even if there is a reduction in the vesting period, it gets nullified with the factor original or total, whichever is greater. I hope you got the picture of what I said, right? I guess you got the mathematical logic in terms of things. Okay, so don't worry, we'll do some questions also in this area. But what we need to understand is that once there is a mandatory replacement, we need to decide what portion is inserted in the entry, that is acquisition entry, and what portion is to be accounted later, that is in a post-business combination. So that depends upon the years which have already completed. So in this particular case, I gave you a simple 3-step model that at the first instance, you organize the data, you just get the fair value on the date of acquisition for the original award as well as for the replace awards. And then you make your pre-business combination, and be careful that in step 2, you need to take the fair value of the original awards. And in step number 3, you need to take the fair value of the replaced awards. That need to be careful, because many people at times, in the step 3, take the fair value of the original awards minus step 2 and take the balancing figure. So when you're considering the step number 3, be careful that in this case, it is original awards, and in this case, it is replaced award. So a proportion of the fair value of the original awards enters the acquisition entry, based on the vesting period completed upon the original vesting, or the total, whichever is greater. Okay, this is one. Now let's come to the next area, and that is a situation where we are saying that there is a complete option replacement. Now, the standard setter said that if you're not allowed, if you're not, mandatory required to replace, and you are doing an option replacement altogether, then this is something, which you're giving in addition. It is not a part of business combination accounting. So they decided that this is not a part of the business combination accounting, because this is completely optional in nature. And if it is completely optional in nature, then let's consider that you are telling them, you work for me in the future, I give you these awards. So here in this particular case, everything relates to a post-business combination only, and you would apply the accounting just like we do for Ind AS 102. So in this particular case, if it is an option replacement, you need to consider the entire awards given as a post-business combination accounting, no impacts on the acquisition accounting entry. Then comes the third situation, and that is we're looking at that there is no replacement. The acquirer company says, no, I will not replace. Now, let me ask you a question. If you remember the discussion yesterday, based on that, let me ask you a question. Try this out. The acquirer company tells the employees of the acquiring company that I will give you my awards, because he is worried that once these shares are given to the employees of the acquiree, his own control will dilute. But if he says, no, I will not replace, then these shares will go to whom? Does it go to the acquirer or does it go to the NCI? Can I say that these options which are given to the employees belongs to the outsiders, not the acquirer company? So they will ultimately go to whom? Can I say the outsiders? Am I right? Is this going to go to the NCI? So I think if you guess this right, that is this going to be, yes, don't worry, Rahul, we will take an example as well. I'll be taking examples on each one of them, typically on no replacement and mandatory. So in this particular case, what we need to watch out is that in this entry, if you say that there is no replacement, if there is no replacement, that means I don't need to create an SBP reserve in the books of accounts as an acquirer. But in this particular case, you can say that this amount of ESOPs will increase the share of the NCI. So in this particular case, what we can do, similar things we'll do, we'll apply the 3 steps just like a mandatory replacement. We're going to apply a similar kind of steps, just what we did in terms of mandatory replacement. See what we're going to do. So in this particular case, since we are not replacing, so there is no new awards. So what do you do in the step number 1? You just arrange a data. In step number 1, you just arrange a data. What are you going to do? You're going to calculate the fair value of the original awards on the date of acquisition. You just need to organize that on the date of acquisition, what is the fair value of the original award, because there are no new awards, no replaced awards. And then you need to consider again the proportion which is a part of the business combination accounting, which is supposed to be a pre-business combination portion. And that is, you take the fair value of original awards, what you've taken in step 1, and apply the same concept. Take the vesting period completed and divided by the original, or maybe if you're planning to change the vesting period, so original or total, whichever is greater, same concept. So we're going to keep the same concept in this case. Maybe there might be a change in the vesting period. Ideally, of course, it might continue to be the original one. And then we take the post-business combination portion, and this is going to be what is the fair value of the original award in step 1 minus the figure which comes in step number 2. So in this particular case, what we need to do, that this amount which is not being replaced will be a part of NCI. The pre-business combination portion is going to be a part of the NCI. And in this particular case, you can say the pre-business combination portion. The pre-business combination portion is going to be recorded as a part of SBP reserve. So in this case, it is being recorded, you can say, as a part of the acquisition entry. In this case also, it is a part of the acquisition entry, but not SBP reserve, because I'm not replacing, but this portion goes to the NCI. So you're going to put an NCI increase in the entry. I know without example, it's a little difficult to visualize these things. But I think we'll just give you a quick consolidation and then do some practical illustrations with you, because it's very difficult to analyze and see what is happening without an example. I understand, I fully appreciate that, but we need to get a larger picture as well. So let's first consolidate the picture to you, and then let's take some examples. Meantime, let me also see if there is any further questions coming in, then we'll take it further. And Janvi sir, in case control retains, then NCI. Yes, of course. Okay, so now let's get the picture very clear. And what we're discussing is the concept of share-based payment awards. So let me just remind you one simple little thing once again, so that there is no confusion at the back of the mind. So let me just remind you the picture which I gave you in the last class yesterday. There is an acquirer, there is an acquiree, there is an acquirer, and there is an acquiree, and there is an employee. So this will give you the larger picture. And there is an employee of acquiree. So let us first of all understand what is happening in this deal. Now, in this particular case, let's say the acquiree company has a number of shares in its balance sheet to the extent of, let's say, 1,000 shares. So let's say he's got a total of 1,000 shares, and the acquirer company has acquired, as I said yesterday, let us say he's acquired 600 shares, which means he's got a 60% stake in the company. And this acquiree company has also issued certain ESOPs to the employee. He's also issued certain ESOPs, which would lead to 500 shares being issued at a future date. Now, you need to understand one thing very carefully. Hear this very carefully, you'll get a better logic. Can I say, if these ESOPs were given for a period of 5 years, for example, and let us say out of this 2 years has already elapsed, and another 3 years is yet to elapse, let's keep that position in mind. So the acquiree company is given the ESOPs to the employees, that is a total of 500 shares. And let us say that out of the 5 years of vesting period, or already 2 years services have been given and another 3 years is yet to elapse. Now, let's see what is the thought process of all these companies. Now, at the first instance, acquirer company considers that once these ESOPs gets converted into ordinary shares, the company's total share capital is going to become 1,500. He understands that once the ESOP gets converted and it becomes a total of 1,500 shares, his percentage will dilute because now he will get 600 shares out of 1,500 shares. So his percentage in this case dilutes to 40% and he's going to lose control. And he's going to lose control in this particular case. So his thoughts are very clear that because of these ESOPs, which will go to outsiders, that is the employees who will also become the shareholders of the acquiree company post ESOPs allotment, he knows that his percentage stake would get diluted. So he may feel that, let me tell the employees that I will give you my shares instead of the shares of the acquiree. But that is the logic with which we started off. That the acquirer company is going to go to the employees and tell them that, okay, I will give you my shares in the company. That's one. Second, we need to also appreciate another aspect as well, and that is, can I say, if these ESOPs were given by the acquiree company, then in his books, can I say he would have already incorporated an SBP reserve as well, right? In his books, he would have already incorporated an SBP reserve because he would have been following Ind AS 102. And he would have done some entries previously, employee benefit expense debit and SBP reserve gets a credit. So in his books, SBP reserve is already there. So now when acquirer replaces the awards, is he also required to incorporate that SBP reserve in his books of accounts? The answer is yes. So if he is going to replace these awards, then just like the acquiree company, he also needs to record an SBP reserve in his books of accounts. But this SBP reserve is not going to be recorded at the same amount. I'm not going to record this SBP reserve at the same amount which is appearing in the books of the acquiree, because everything is to be done on the basis of fair value accounting, right? Since everything is to be done on the basis of fair value accounting, I will say, okay, tell me what is the fair value of the original awards on the date of acquisition. I will say, okay, tell me what is the fair value of these original awards on the date of acquisition so that I can decide the amount of SBP reserve to be created in the acquisition entry. So I get the fair value of the original award on the date of acquisition, but on this basis, I can't be putting the entire fair value in the books of accounts right now. If you know Ind AS 102, you take, keep a proportion based on vesting period. If it is 3 years, you say 1/3, and then in the next year, 2/3 minus year one, and so on. So in this particular case, I need to consider definitely a proportion. So what should be the logical proportion? The vesting period which is already completed. The vesting period which is already completed upon the total vesting period, which in this case is what we are calling it as the original vesting period. That makes complete logical sense. That if he's replacing the awards of the acquiring company, then he needs to put in as a part of the acquisition entry in SBP reserve in his books of accounts. And this SBP reserve gets recorded at a proportion of the fair value on the date of acquisition based on the completed years 2/5. So in this example, it is indirectly 2/5. But again, as a part of the deal, what happens that if you want to induce these employees to get your awards, you will tell them, okay, I'm going to reduce your vesting period and I'm going to make it a period of 4 years so that they feel incentivized and they feel, okay, we'll take the awards of the parent company, because everybody may not be happy taking the awards of a new company. So in order to induce them, you say, okay, we'll change the vesting period to 4. So in this particular case, the question arises, then what do we do with the proportion? So the standard setter said, you will take the original or the total, whichever is greater. So which means original is 5 and the total now is 4. 2 elapsed, another 2 left over, the total is 4. So you need to consider the greater of the 2, for which I give you a logic. For which I give you a logic that companies were also trying to manipulate and push a smaller portion for the post-acquisition accounting. So they decided that you're going to take this proportion as a part of the PC. Now come back. Now, if you come back and see the logic, you are going to understand the 3 steps. So what I did, in the step number 1, I organized the fair value on the date of acquisition for both the original and the replaced awards, just getting the data. And we need to take a proportion of the fair value of the original awards as a part of the acquisition entry. So what we did, we took the fair value of the original awards in step number 1 and took the proportion that is vesting period completed upon original or total, whichever is greater, so that the SBP reserve gets incorporated as a part of the acquisition accounting. So basically, the acquirer also lands up recording the SBP reserve, for which I gave you that there are 2 inputs. Either you add this step number 2 amount in the PC and then put a separate entry PC to SBP reserve, or you can simply incorporate the SBP reserve in the entry itself. It's your choice. That is what we did. So basically, the step number 2 is going to give you the amount which you will add to the PC or incorporate it as a SBP reserve in the entry. And then I took the amount which is relating to post-business combination, where Ind AS 102 would apply. So I would say now you've got an original award. So you've got a fair value of the original award minus what you've already incorporated as an SBP reserve. So the balance is going to be accounted in the post-business combination period. I guess now it makes more logical sense. I think I've given you good enough logic on that. Okay, I think Jay, you said, so why does the debit PC and SBP reserve in a pre-business combination? Well, as I said, you've got a complete choice. You've got a complete choice. You want to add it to the PC and then segregate the SBP reserve with a separate entry, you can do that. As a part of this entry itself, you incorporate that SBP reserve as a separate credit. That works as well. Both alternatives are perfectly okay. Okay, and number 3, you said, so how to calculate the fair value of the award? Is it given in the question? It will always be given in the question, because this fair value is not a fair value as per Ind AS 113. This fair value is a fair value which is based on Ind AS 102, because the concept of fair value in 102, that is not as per 113. Because 113 also makes a very clear exclusion that when you calculate a fair value for the purposes of share-based payments, it is not based on 113. So this fair value is something which you calculate using a Black-Scholes model, and this would 100% be given in the question, of course. Okay, so now let's come back. So I think we fairly understood the 3 steps. The second case is pretty simple. If there is an optional replacement, then you tell the acquirer, okay, you're giving these replacement award for the future services by the employee. So this is not a part of the business combination accounting. You just apply Ind AS 102 the way we ordinarily do. And if the third case comes that you say that there is going to be no replacement in this particular case, now you need to remember that if there is no replacement, let's get the logic very clear. If there is no replacement, that means acquirer says, I am not going to give you the shares. Then these shares will ultimately go to whom? Because once the shares get converted, it is a potential ordinary share. The ESOP is like a potential ordinary share, which ultimately will go to whom? To the outsiders other than the controlling interest. So then they become a part of the NCI. So what we have done, we've taken a simple case, the three-step model, but this is going to be a part of the NCI. So in the entry, you will increase the NCI. So if it is a case of no replacement, instead of putting SBP reserve, in this case, you're putting an SBP reserve. In this case, you'll increase the NCI because this is belonging to the NCI. I hope I am fairly clear. Let's do some questions with you on this area. I think things will become even more clearer. Okay, so let's begin the journey. I'm now going to take you back on the assignment. And I've just added a few questions on the concept of share-based payments. So let's have a look at a few questions on share-based payments. Let's begin with a simple question, number 22. So this is one of the questions which is given in the education material, and this is a good one to understand the concept. So let's have a look at the question number 22. I hope the visibility is perfectly okay. So let me just read the question. We need to read and decide the case as well. You need to be very careful and decide that is it a case of mandatory replacement, is it a case of no replacement, or is it a case of optional replacement? You need to do that because mandatory means SBP reserve, no replacement means NCI, and optional replacement means no Ind AS 103, simply 102. Let's read. Now, question number 22, I am given. It says on 1st April 22, the company ABC Limited, it says the company ABC Limited granted equity settled share-based payment awards with a grant date fair value. This is the fair value which is given on the grant date. So that is when it was originally granted. It says with a fair value of 1 lakh to the employee, which is subject to a 3-year service condition. So the company ABC is given equity settled awards to their employees, and that has got a 3 years vesting period. The company XYZ acquires the entire shares of ABC on 1st April 16. So that means after 2 years, the awards were given. So that means out of the 3 years of vesting period, you can say 2 years vesting period is already expired. And as a part of the acquisition accounting, it is required. It says it is required. It is required. Do you think I need to tell you that which case is this? It says it is required. It is indicated that this is a case of a mandatory replacement. The wording of the question is very clear that it is required to issue equity settlement replacement awards to ABC's employee. So as a part of the acquisition accounting, it is required. That means it's mandatory. He has to issue them. So the question arises, is the company, the acquirer company XYZ, supposed to incorporate SBP reserve as a part of the acquisition accounting entry? Yes. And this is going to be based on the fair value of these awards on the date of acquisition with a proportion depending upon the period which has already elapsed. It says at the date of acquisition, the market base. So it says very clearly on the date of acquisition, the market-based measure of the original awards is given and the market-based measure of the replacement award is given. He's very clearly told you what is the fair value of the original awards, what is the fair value of the replaced awards on the date of acquisition. The replacement awards have a 1-year vesting condition. So 1 year was actually left and they never made a changes to that. They said, okay, we're going to continue with the same 3 years vesting period. It says determine the amount attributable to pre-business combination service and a post-business combination service in a situation where all the employees are expected to meet the service condition. So we are considering that every employee is going to meet the service condition. So we're going to apply a simple three-step model and get the data. So I think let me just organize the answer to you separately to get more clarity of thoughts. So in this particular case, I think let's apply the three-step model. So I'm looking at the answer to the question number 22. So let's understand this on a step-by-step basis so we get a complete clarity. So what I'm going to do, I would first of all tell the examiner that I've read the question carefully and I know that it is a case of a mandatory replacement. So let me decide the three steps, get my step number one, and I will organize that what is the fair value, or you can call it as a market value. This is the market value which is on the date of acquisition, because the incorporation of the SBP reserve of acquirer will depend upon the fair value on the date of acquisition, the market value, not as per 103, but as 113, but as per 102. So the market value of the original awards and the market value of the replaced awards. And this is, I think, very clearly given. It's 1,80,000 and I think this is 2 lakh. Let me just get the figures corrected. Yes, it's 180 and it is 2 lakh. So this is very clearly given to me. I just organize the data and the step one is done. Then we go to the step number 2. And I said, I want to identify what relates to the pre-business combination, which can be inserted as a part of the acquisition entry. So in this particular case, I said, okay, let's take the fair value of the original awards in step 1. What is the vesting period completed? It's 2. Because you need to account a proportion of that 180 and put it as a SBP reserve in the books of accounts. So 2 years have already elapsed and the original as well as the total vesting period, both are 3. So if you calculate this, this is coming to a total of 1,20,000. This is pre. Now in step number 3, let us also calculate what relates to the post-business combination. Now here you need to be careful that when you're looking at the post-business combination portion, many people, simply say, okay, 180 minus 120, 60. No. You need to be careful that you now need to consider the fair value of the replace awards minus what you've already created as an SBP reserve. The balance is which is going to be accounted later. This is going to be accounted totally based on Ind AS 102. So let us also see that what is the journal entry which we are going to pass in step number 7. Let us also see the journal entry which we're going to pass in step number 7 as a part of the acquisition entry. As I said, you've got 2 alternative choices. When you record the net assets debit and you record the purchase consideration credit, do one thing. Insert 1,20,000 as a part of the PC. Do one thing, include this amount in the purchase consideration, and then you put a separate entry that is purchase consideration debit and SBP reserve gets a credit, and this is 120. This is one alternative you can do. That you include it in the PC and then do a separate entry. You don't want to do that, not an issue. The second alternative is that in the acquisition entry itself, instead of taking it in the PC, directly record 120 on the credit side. Directly put this SBP reserve on the credit side of the entry. It's one of the same thing. If you look at the net effect of this, it is the same thing. So you want to record it as a separate credit in the entry, fair enough. You want to include it in the PC and then segregate the amount, fair enough. Did we get the logics now? Are you clear now, friends, with the logic in terms of the mandatory replacements? Okay, I think a few questions coming in. Let me answer that. And Kaushik, you said so option replacement means options with employee. Well, option replacements in this particular case would mean, yes, that we are indirectly saying that it is purely optional. That means I am giving this as a free will. So if it is a complete free will, then it is not a part of the business combination accounting. Okay, and Jay, you said, so what if acquirer cancels the share-based payment award? Well, I think we'll not get into all that because that's more to do with accounting under 102. So in this particular case, that would be a separate standard altogether. So we won't discuss it here. And you said, why no replacement is a part of the NCI? Why no replacement is a part of the NCI? We said that if there is no replacement, it is a part of the NCI only. We never said it's not a part of the NCI. We said it is a part of NCI. Okay, and a number of you said, so step number 2, pre-business combination, fair value of the original awards. Okay, I think you gave the formula for that. That's right. Okay, that's wonderful indeed. Okay, so I guess now you got a fair idea that what we are doing in this particular case. So this was an example based on a mandatory replacement. So we need to understand a basic thought that there is an SBP reserve in the books of the acquiree, and as a part of the mandatory replacement, you need to also incorporate that SBP reserve in the books of the acquirer. And the amount at which it gets recorded is based on the market value on the date of acquisition, 1, and the proportion is supposed to be the period completed upon the original or total, whichever is greater, and it gets incorporated as an SBP reserve in the acquisition entry. Okay, let's do another question with you. So this was one question. Let's take another question with you. I am just going to go back to question number 23. So let's have a look at the question number 23. Okay, so let's see. The question number 23, let me just read the next question to you. This is a question which is given in the study material. Let's read. It says Green acquired pollution as a part of the arrangement and it had to replace. I think let me ask you that question. When it says it had to replace, what does this mean? It had to replace the existing awards. So I think you would understand had to replace is very clear that it is again a case of a mandatory replacement. So I think similar calculations would follow. So I think I can give you that question. You can keep trying it. It's a study material question. So you can keep trying that question with you. Let's take another question with you, which is also in the study mat. Question number 24. This is also in the study material. And let's have a look at this question. Now you need to read and decide, is it a case of mandatory, optional, or no replacement? Let's have a look. So let me just, I think, zoom in a bit further. Let's read. It says P, a real estate company, acquires Q. So P acquires the company Q, another construction company, which has got an existing equity settled share-based payment scheme. The awards will vest after 5 years of employee service, and at the acquisition date, the employees have already rendered 2 years of service. So out of 5, 2 years already elapsed. Then he says none of the awards are vested at the acquisition date. P did not replace the existing share-based payments, but reduced the remaining vesting period from 3 to 2 years. I don't think so. I need to tell you which case is this. It is very clear that P said, okay, let's continue with the same share-based payments. I will not replace. So he did not replace. So it's a clear-cut case of no replacement. In my case, it is the third situation. So in this particular case, you're going to apply the same 3 steps, except that in this particular case, you're going to record this not as SBP reserve, because you don't need to incorporate this as an SBP reserve, but it is something which is a potential NCI. So this is going to be inserted as a part of the NCI. Let's see the calculations. Company P determines that the market-based measure of the award at the acquisition date is given. And this is based on 102, determine the accounting treatment. I think I'll simply do the 3-step model here itself. So in this particular case, I go to the step number 1. I said, okay, let me organize the fair value of the original award on the date of acquisition. Because now there is no replacement award. So you just got to identify what's the fair value of the original award. And that is given to me 500. Then I go to the step number 2. And in terms of step number 2, we decide what relates to the pre-business combination. which is to be inserted as a part of NCI in the acquisition entry. So we consider the fair value of the original award in step 1 divided, and the proportion is 2 years complete. And now we know that the original vesting period is 5, but the new vesting period is being reduced. It says from remaining 3 to 2 years. So 5 or 4, whichever is greater. And I give you the logic of why are we considering greater of the two. So this becomes 200. This is going to be taken as a part of the NCI. And if I want to calculate the step number 3 as well, what relates to the post-business combination period, I would say 500 minus 200 in step 2, 300 relates to post-business combination to be accounted under Ind AS 102. Now, if you ask me what is the journal entry for this proportion, when you take your NCI in the acquisition entry, increase it by another 200, which is a pre-business combination portion. Simple and straight, right? I guess, friends, are we pretty clear now in terms of the share-based accounting? Okay, that's wonderful. I think we got the right answers on that. Kaushiki, sir, now it is how it is decided it is mandatory optional in a practical life. Okay, I guess that depends upon the negotiation terms between the acquirer and the acquiree. So in any case, you're going to see that a lot once you get into the practical life. You'll realize that the level of Ind AS which you've studied for the examination point of view is far quite less as compared to what you're going to see in a practical life situation. Trust me, I've asked very basic questions to people at times, and they falter on that particular concept. Okay, can I take a liberty of telling you something, which is very important indeed? And, I think as prospective qualified chartered accountants, you need to know that, because many people don't even know this. So I think, let me tell you something very interesting, which is, I think every student should know this, but, sometimes people don't even know this. So let's give you something very basic to understand, not getting into any details. Okay. When you prepare your books of accounts in a practical life as well, you've got a journal, and then you make a ledger, then you make a trial balance, and then you start making the final accounts comprising of your balance sheet, etc. So this is the sequence in terms of accounting. And, I remember, asking people, when you hire people, you ask them certain questions, and you said, okay, if Ind AS applies to the company, can you tell me the journal entries will be as per Ind AS or not? I think let's get that answer from your side as well. If the company applies Ind AS, so are they going to pass journal entries, make the ledgers and trial balance as per Ind AS? Give me the answer, yes or no, or you could say, I don't know. I'm going to keenly wait for your answers. So the company is applying Ind AS, it is covered under Ind AS. So when they're going to make a journal ledger and a trial balance, is that going to be based on an Ind AS or not? You can say the answer yes, you could say the answer no, or you could say I don't know. That's IDK. I'm going to wait for your answer before I tell you anything on this. I'm just a little out of the Ind AS 103 at the moment to give you a little practical knowledge on this area. Okay, so I think we got the answers yes, and that is the biggest misconception people have. The biggest misconception, because we don't get exposure on the practical part. Now let's explain you what happens in a practical life. Even if the company is applying Ind AS, all this is going to be done on the basis of IGAAP. All this is going to be done on the basis of IGAAP. I think I got one answer from Rahul. No, that's right. So the company is going to follow IGAAP. The primitive accounting is what they're going to follow and generate a trial balance. But this final accounts is going to be made as per Ind AS. This is going to be made as per Ind AS. So now there is a gap, because your trial balance is IGAAP and your final accounts is Ind AS based. So what they do, and there is a genuine issue, why you need to follow an IGAAP, because if you follow the Ind AS in journal entry, ledgers and all, what is going to happen in this particular case? How will you, calculate your income tax liability where they don't consider Ind AS? How are you going to calculate your GST liability, which they don't accept Ind AS? Because in India, you see a lot of places which is totally in contradiction with what Income Tax Act or what the GST would apply. So I need to generate a trial balance, not only from the point of view of my income tax, my GST, etc. And then what I'll do. In a practical life, what the company is going to do, they're going to hire an expert, or maybe they do it on their own. They maybe do it on their own, but they are going to pass the Ind AS adjusting entry. They're going to pass these Ind AS adjusting entries in this particular case. So what we are going to do in a practical life is that if you're wanting to look at these Ind AS adjusting entries, I need to follow the concept of rectification chapter you did in school. You need to see what is the entry which was done as per IGAP. You need to see what is the entry which is done as per Ind AS. Compare the two entries and get a rectification entry called Ind AS adjusting entry. You will now incorporate these Ind AS adjusting entries in the trial balance and then generate a financial statement. When you study the Ind AS at the final level, the focus is always giving you entries from the Ind AS point of view. You are basically learning this. You're basically learning this in CA final, and in a practical life, you will not be passing these entries. This is a homework which is being taught to you. So you will look at what entries have already been done, what entries should have been done, comparing the two and then passing these entries. In the examination perspective, we are not asked these particular entries, but in a practical life, this is what you're going to do when you're going to make the Ind AS financial statements. So if you're doing auditing as well, in the audit, you will first audit this trial balance on IGAP levels, and then you're going to audit these Ind AS adjusting entries with your Ind AS knowledge, and then finally you finalize the financial statements of the company. So this is, I thought, was very pertinent to tell you all. And also Ind AS adjustment entries outside the books, right? Yes, of course, this is nothing to do with the books of accounts. So you just make a separate Excel sheet and you incorporate that as a part of the trial balance and generate the financial statements, which is the requirement of the Companies Act and which is to be generated as per Ind AS. So your trial balance on IGAP serves well for the income tax, for the GST point of view, and then you generate the financial statements for that purpose, right? Okay, I think Namrata, you would have got your answer. Why is it like this? Because in any case, when you generate a trial balance based on an Ind AS, it's going to be problematic. Income tax and GST is not going to work upon that. You applied so many concepts in Ind AS in terms of unwinding of discount, in terms of other things, that it's going to be a complete mess. So the provisions of the income tax and the GST are more aligned with the IGAP, so that no company can actually afford to do this. Every year they will sit down and do the Ind AS adjusting entries and then incorporate them and make the financial statements, right? So that was a little practical edge to you, friends. I thought you must know this as well. Anyway, let's come back. That was a little practical knowledge. I think somebody asked me a question, so I thought it's pertinent to give you an answer on that. Okay, now let's get on to the next area of discussion. We are on step number 4, purchase consideration. Now, very interesting. There is another 7th issue in the calculation of the purchase consideration. There is a pre-existing relationship. So we are now discussing another aspect in terms of the purchase consideration. So we are discussing the concept of pre-existing relationship. A concept of pre-existing relationship, and this is also slightly technical. So we need to go carefully on this because, 3 components of the purchase consideration is slightly heavier in nature. We did one of them, step acquisitions, that is PHI yesterday. We just did a share-based payment, that is a bit technical, and even this one is slightly technical in nature. Now, what is a pre-existing relationship? Let's imagine there is an acquirer. And let's imagine there is an acquiree, and they had transactions before the date of acquisition. So they had transactions before. So they had transactions before. So they had transactions before the date of acquisition. So this is what is called pre-existing relationship. So they may be a debtor-creditor relationships, or maybe there might have been some loans, etc., or court cases against them, whatever. So the transactions which were entered before the date of acquisition could result in some kind of transactions between them. So the question arises when you calculate a purchase considerations. Sometimes the amount which is paid is going to be including the settlement of the pre-existing relationship. So the acquirer, as a part of the deal, will tell the acquiree that let's also settle the pre-existing relationship. So if these pre-existing relationships are settled, we need to make some adjustments to the purchase consideration as well. Now, there is a very interesting guidance which is given in Ind AS 103 that if there are pre-existing relationships, how do you consider that? So let me take you to those relevant paras and understand things. I know what I'm about to discuss is very, very technical. And continuously you'll tell me, sir, example though. बिना एग्जाम्पल के मैं सोच नहीं पा रहा हूं. No worries, I will give you an example also. So what we'll do in the technical area, we'll continuously explain with an example. So let me first take you to the study material, and let me just take you to the extract of the pre-existing relationships guidance. So I'm just going to take you to the study material, and let's have a look on the pre-existing relationships with you. Okay, this is the interesting part. So let's have a look out here. Okay, so I guess I am going to first of all show you something. Just a small little line, and then we take to the larger picture. So there is a small line on this page, page number 13.51. Just look at the page number 13.51. I'm just looking at the last line. Then I need to take you to the next page. So page number 13.51 of the study material. Let's read what is given. This is the para number B52 of Ind AS 103. This is the appendix B, which gives us if the business combination in effect settles a pre-existing relationship, as I give you the focus that if there is a settlement of a pre-existing relationship, the acquirer recognizes a gain or loss measured as follows. Now, don't worry, I'm just going to first give a plain vanilla reading in terms of the inputs, and we'll take a good examples. Don't worry, the next 15-20 minutes or maybe a little more is going to be very crucial. But that will finish step number 4. 5 and 6 is very easy. So it says that if the business combination in effect settles a pre-existing relationship, the acquirer has to recognize a gain or loss. And what is the amount of gain or loss? Let's have a look at this. This is an extract of what is given in para number B52, and watch this carefully, what is stated out here. It says for a pre-existing non-contractual relationship, focus. When you look at a pre-existing relationship between the acquirer and acquiree, you need to first of all identify that the relationship is contractual or non-contractual in nature. Then only the accounting treatment can be decided. Like in share-based payments, you made a focus mandatory, optional, no replacement. You need to get the focus here as well. And in this particular case, what you need to do, you need to basically consider that there is either a contractual relationship or there is supposed to be a non-contractual relationship. So it says for a pre-existing non-contractual relationship, the example is a lawsuit, and that is he only gives me a guidance in terms of the fact that in terms of a lawsuit, it is an example of a non-contractual relationship. You need to recognize a gain or loss equal to fair value. You would say, sir, I didn't understand that if there is a pre-existing relationship which is non-contractual in nature, you're recognizing a gain or loss equal to the fair value. Let's take an example. Let's take an example and let's see. There is an example which is given in the study mat as well. Let me just take you out there. I guess maybe I have a question. No, this is not out here. Sorry, we don't have a question right now. I'll just take an example to illustrate this part that there is a non-contractual relationship. Let's take a very basic example. I'll just add an example out here. Just have a look. So just see this example very carefully and we'll understand this. So let's say there is a company A Limited and let's say there is a company B Limited. And this is an acquirer, this is an acquirer, and this is an acquiree. So let's say there is an acquirer, an acquiree. Now watch this example carefully. I'll come back to the language which is given. Now let's say this is before the date of acquisition. Before the date of acquisition, company B filed a suit against A. Let's say company B filed a suit against company A. So this is before the date of acquisition that he filed a court case against him, claiming a compensation and saying that you need to compensate me, let's say 10 lakh rupees. I'm intentionally taking the example the other way around. It could be other way around also, that A filed a case against B, but I want to understand that the acquiree company filed a suit against the acquirer. So let's say before the date of acquisition, the company B filed a suit against company A for 10 lakh rupees. Company A made an assessment as per Ind AS 37. Company A made an assessment as per Ind AS 37 and he decided that this is a case of contingent liability. I am not going to lose the suitcase. So he decided as per Ind AS 37 that this is a case of a possible obligation and he said it's a contingent liability in the notes to accounts. Now after this, A now acquired the business of B. A now acquired the business of B, got a control over B, and Ind AS 103 triggers. Now once the Ind AS 103 gets triggered in this particular case, we can say, once the Ind AS 103 gets triggered in this particular case, we can say that once Ind AS 103 gets triggered in this case, we can say in this particular case, B Limited tells A. B Limited tells A in this particular case that, okay, you are going to give me a purchase consideration, let's say to the extent of 50 lakh rupees. And this is including, he says you're going to give me a purchase consideration, 50 lakhs, including that 10 lakh rupees as well. He says, but boss, if you want to buy the business, let me first of all be very clear. You need to settle that 10 lakh rupees first and then buy me. It doesn't mean that if you're going to buy me, you're going to dictate me. You know, I have a case against you. So you're going to pay me a 50 lakhs of consideration, including 10 lakhs for the compensation for the court case. So in effect, what is the purchase consideration, which is a business combination? Isn't it 40 lakhs? Isn't that technically 40 lakhs? Because A is going to buy the business of B and pay him a consideration of 50 lakh rupees, which is including 10 lakhs paid for the court case settlement. So this 10 lakh is a pre-existing relationship settlement. And 40 lakhs is technically the amount of purchase consideration. So in this particular case, imagine when I do the acquisition accounting entry. When I do the acquisition accounting entry, before the acquisition accounting entry, what am I going to do? I will put the entry, this is in the books of A, I will put the entry profit and loss account debit, and the payment of 10 lakh has been made, bank gets a credit to the extent of 10 lakh. So in this particular case, the entry is going to be profit and loss account debit, and the bank is going to get a credit to the extent of 10 lakh. So we'll put the entry P&L debit, which means since I have not recorded any provision in the books of accounts, but I had to pay this 10 lakh rupees as a part of the pre-existing settlement. So we take a hit, and this is a loss on account of a pre-existing relationship. Then when I put the acquisition entry, you're going to put the entry net assets debit. The purchase consideration is given a credit at 40 lakhs. So we made a reduction of that 10 lakh rupees from the purchase consideration. That's one. So indirectly, you need to see that if the purchase consideration is including the amount which is paid for the settlement of the pre-business combination, you make a reduction of that, and you also recognize a loss on account of settlement. Let me just consolidate the picture once again, and so that it becomes amply clear in this particular case. So let me just quickly give you the inputs on this. Okay, so let's, I think, take this further. And give you the inputs in this particular case. So the input which I am giving in this case is, number one, I'm just concentrating right now on a non-contractual relationship. I'm just focusing on the non-contractual relationship at the moment. So I'm working on a non-contractual relationship at the moment. Now, in terms of the non-contractual relationship, let's consider acquiring company filed a court case against the acquirer company pre-business combination. Before the acquisition took place, the acquiree filed a case against him. And when he filed a case against him, in this particular case, when he filed a case against him, he said that you need to pay me 10 lakh rupees. A, in his books of accounts, applied Ind AS 37 and decided it's a contingent liability. So no provision was created in the books of accounts. He never recognized this as a liability in the books of accounts. Now, when he decides to acquire the business of the acquiring company, B tells him, boss, you need to give me this 10 lakh rupees. You got to settle the pre-existing relationship before we talk any further. So he says that as a part of the purchase consideration, you pay me 50 lakhs, including 10 lakhs for settlement of that court case. So we need to be clear that the purchase consideration is got to be excluding the pre-existing relationship. So when you calculate the purchase consideration, you need to reduce the amount which you had to pay to settle the pre-existing relationship. And then you need to put a separate entry, and that separate entry is profit and loss debit, and bank gets a credit. So you're recognizing a loss on account of settlement of a pre-existing relationship. I know the question which is coming to your mind now, sir, if he would have recognized a provision under Ind AS 37, let's say to the extent of 6 lakh rupees, then would the first entry undergo a change? Yes. I would now take a debit to the provision to the extent of 6 lakh, and then the PL gets a remaining hit of 4 lakh rupees. So there are two situations. If we did not create a provision, then the entire fair value gets debited to the P&L. If he's already created a provision in the books of accounts, then you take only the remaining hit in the profit and loss account. I hope, friends, with this example, you got the position in terms of things. Like, okay, I think Rahul, you said like intercompany owings as well. Yes, there could be settlement of debtors, creditors relationships as well. So there could be, a settlement in terms of a debtors, creditors relationship as well. They're all part of the pre-existing relationship, but let's take it further. So this is well understood, I guess. Let me now come back on the picture. So the first thing which you need to watch out, is that you need to first of all evaluate. You need to first of all evaluate in this particular case that if the pre-existing relationship is non-contractual in nature, then it gives you examples such as a lawsuit. You need to recognize a loss. It could be again would arise when it's the other way around. As an acquirer, I filed a court case against the acquirer, right? So there would be a loss to me if he has filed a case against the acquirer, and there could be a gain if I filed a case against him. And then it says below, the amount of gain or loss recognized may depend in part on whether the acquirer had previously recognized a related asset or liability. So if you already had a provision in the books of accounts, He says then the amount of gain or loss may differ. The reported gain or loss may differ from the amount calculated by applying the above requirements. I've already explained that the amount of loss to be taken in the P&L is the fair value minus the provision, if any. I would put it like this. The amount of loss I would recognize on a pre-existing relationship settlement is, you can say, the fair value, which is 10 lakh in the example, minus the provision of 6 lakh. So we would take a hit of 4 lakh. This is one. Now, there is another input which is a bit complicated, which needs to be illustrated with an example. The second permutation combination is that if there is a contractual relationship. Now, when you look at a contractual relationship, that means the relationship was on account of a contract they entered earlier. Like, for example, there could be a situation, I would like to talk about reacquired rights. So let's say A Limited gave some franchisee rights to B. A is the acquirer and B is the acquiree. So let's say before the business combination, A Limited gave some franchisee rights to B. So in this particular case, they had a contractual relationship. So if there is a contractual relationship, the gain or loss is the lesser of 1 and 2. Now I'm going to read 1 and 2, but I'll have to take an example to illustrate this. So don't get worried on the language. It says the amount by which the contract is favorable or unfavorable from the perspective of the acquirer when compared with the terms, that is the current market terms. So I need to see that if I look at the current market terms vis-a-vis the terms on the basis of which I dealt, is it good or bad? We'll see that. And then it says the amount of any stated settlement in the contract available to the counterparty to whom the contract is unfavorable. If 2 is less than 1, the difference is a part of the business combination. Sir, kuch bhi samajh mein nahi aaya. So we could not understand any bit on what he's saying, that the gain or loss is the lower of the 2, and this is comparing blah, blah, blah. I'll explain with an example. Let's, I think, take you to a wonderful example. This is illustration number 20 in the study mat. Let's have a look at the illustration 20 with you, friends. Now watch this carefully. So we're looking at the illustration number 20 in the study material, and let's read this and we'll get the picture that if there is a contractual relationship, how the accounting is done. Let's have a look. It says ABC acquires PQR consideration of 1 crore. 4 years ago, which means pre-existing relationship, ABC granted a 10-year license allowing PQR to operate in Europe. So company ABC granted a license to the acquiring company 4 years back. So when he granted a license to the acquiring company, they definitely had a contractual relationship with each other. Then he says the cost of the license was 250,000, and the contract allows either party to terminate the franchisee at a cost of unexpired initial fee plus a 20%. So basically, they entered into an agreement where the acquirer company took an amount of 250,000 to give this intangible asset the rights in terms of franchising. So 4 years back, he said that, okay, we are going to charge you 250,000 and I'm going to give you 250,000. This right will be given to you on account of 250,000. So which means what is the value of the intangible asset in the books? Initially, the intangible asset would have been recorded at 250,000, which is a franchisee right, and he would have recorded it as per Ind AS 38 in his books of accounts. Now, this intangible asset is going to be amortized over the period of time. And since the right is for a period of how many years, we need to see. So in this particular case, the right was granted for a period of 10 years. So we can say the annual amortization is supposed to be 25,000. So 2,50,000, the intangible asset was recorded in the books of accounts with a 10 years life. The annual amortization in this particular case works out at 25,000 rupees. So over a period of 4 years, since 4 years have already elapsed, so what is the total book value? Can I say 2,50,000 minus 25,000 for a period of 4 years? You can say the book value of this franchisee is going to be 1,50,000. So just get the facts very clear, that the company ABC granted to the company PQR a 10-year license, and the cost of the license is 250. So we can say in the books of PQR, it would appear as an intangible asset, and that intangible asset is amortized over a period of 10 years, considering the license is 10 years, 25,000 annual amortization. Since it was 4 years back, the current book value of the intangible asset in the books of accounts is 150. You can call this as an unexpired initial fee. The word unexpired initial fee is like the book value. So they also decided at any time they want to cancel this right, then either party, what they have to do, they need to pay the book value plus 20% as a compensation to the other party. So it says that the contract allows either party to terminate the franchisee at a cost of unexpired fee. The unexpired fee is what? It is 1,50,000 as we calculated, plus another 20%, that makes it 1,80,000. So this is the amount of penalty which you need to pay if you want to exit out of this contract. So it says at the date of acquisition, this is the settlement amount. So which means if I want to cancel this particular contract, I tell the other person, okay, whatever is the book value and plus another 20%, take this 180 and the contract comes to an end. Then he says ABC acquired PQR because it sees a high potential in the European market and it wishes to exploit it. ABC calculates that under the current economic conditions and at the current prices, it could grant a 6-year franchisee at 4,50,000. Now, you need to understand one thing, that what is the book value of this particular intangible asset? The book value of this intangible asset is 1,50,000 in the books, and the remaining 6 years are left. If he would have given this franchisee today to someone, then it would have given him an amount of 4,50,000. So he would say, oh my God, that was a bad deal. So in any case, number one, let's first of all get one thing very clear. Number one, is this a case of a reacquired right? You gave a right to the acquiring company earlier, and now you want to terminate that agreement and get the right back because you see a good potential in the European market. So you're telling the other company, boss, 4 years back, I gave you a right. Now I'm going to acquire your company. Number one, I'm going to cancel this right. And number two, I'm going to get this right back. So if I'm going to get this right back, it becomes technically a case of a reacquired right to me. And if it becomes a case of reacquired rights, are you going to record this in the books of accounts at 150, which is appearing in the books of the acquiree? Of course not. You're going to record this at a fair value, which is 4,50,000. Step number 3B is what I'm talking. So can you come again? I'll tell you. Let me just add more inputs to this. Let's, I think, just add another page out here. Let's take this example further. So let's have a look further on this example. So we are considering there is a company A and there is a company B, and this is, let's say, acquirer, and let's say this is acquiree. So these are the two companies, acquirer as well as the acquiree. Now let's watch this further. So continuing with the same example, let's understand one thing, that 4 years ago, this is pre-existing relationship, he gave a franchise rights. He gave some franchisee rights to B Limited. So when he gave a franchisee rights to B Limited, in this particular case, it was given at 2,50,000. It was given at 2,50,000 and it was given for a period of 10 years. It was given as a part of the deal. He said, okay, I'm giving you for a period of 10 years. So the annual amortization was 25,000. And since 4 years have already elapsed, we can say the book value as of today is 150. I think that's pretty clear. So in this particular case, you can say the book value of this franchisee right in the books of the equerry is appearing at 150. Now, what does A Limited do? He says, now I'm taking over the business. He says, now I'm taking over your business. So there is a takeover of the business. So he says, I'm going to cancel this right. He says, I'm going to cancel this right. In order to cancel the right, they decided that there will be a compensation. So he said, okay, whatever is the book value, I'll pay you 20% more than the book value. So this 1,80,000 is what I'm going to pay as a part of the settlement, right? This is what I'm going to pay as a part of the settlement in this case. Now, let's understand only till this stage. Let's get back to the acquisition entry. Let's get back to the acquisition entry, the step number 7 to understand more. Can I say I'm going to first of all put the entry net assets will be given a debit. Now, when you're going to record this net assets, you cancel this and then it also becomes a reacquired right to you. Once you cancel this, it also becomes a reacquired right to you. Because you gave this right, you cancel it, and you reacquire it back again. So the question arises that once this is a reacquired right, what is the value at which it will be recorded? It is appearing in the books of the equerry company at 150. So are you also going to record it at 150 in the entry? Of course not. It is going to be recorded at, you can say, the fair value if you would have given this right today, but for the remaining period. That's crucial because the 4 years have already elapsed. So the remaining period is 6 years. So the question tells me the data that if you would have given this right for another 6 years today, then this reacquired right would have been given at 450. So as a part of this net asset, you should also record this reacquired rights as a part of the list at 4,50,000. You're going to put this as a part of the acquisition entry, list number 3B. So you're going to put this as a part of the acquisition entry, that is list number 3B. This is one thing, that this reacquired right appears as a part of the acquisition entry at a fair value, which is based on the remaining period of 6 years, 1. Secondly, when you look at the purchase consideration and take a credit, you are going to pay 1,80,000. You are going to pay 1,80,000 to cancel this right. So does it make sense that from the purchase consideration, you reduce this 180 and put a separate entry before this, that is profit and loss account debit, and bank gets a credit, and this is to the extent of 1,80,000. Doesn't that make sense? So you're going to settle that pre-existing relationship. You're telling the person, okay, boss, I'll pay you this 1,80,000 as a compensation. So I will put this in my profit and loss. I pay a compensation of 180 and I do a separate entry. And the amount which I paid as a part of purchase consideration, if it includes the settlement of the pre-existing relationship, you are indirectly reducing that 180. You're indirectly reducing that 180. Now see, in effect, 450 is taken on the debit side, 180 is got reduced. So effectively, you can see what is a part of the business combination is the remaining 270. My discussion is still not complete. I need to come back and show you something. Let's have a look back again. Let's have a look back again, and let's read the clauses once again to appreciate the larger picture. So let me just clear this bit. And I know I'll have to consolidate. I know it is quite technical indeed. No worry, we will consolidate all the inputs, but let's get the first explanation done. We'll give you a mind mapping and we'll consolidate the inputs. No worries on that, but just let's have a look further on this. I know you're due for a break as well, but just bear with me for a few minutes before we give you a break to relax your minds. So it says when there is a pre-existing contractual relationship, the lower of the two is a loss. It says the lower of the two is a loss. While giving the example, I simply calculated that the loss is the compensation paid. The amount which you need to pay to cancel the deal is supposed to be the loss. Now see what it says. The amount of any stated settlement provisions in the contract. So what was the amount to settle the deal? You got to pay 1,80,000 to settle the deal. So the acquirer company said that I had given you a right for a period of 10 years, 4 years have already elapsed, but I want to cancel it right now. So he said, boss, anytime you want to cancel, you got to pay me the book value plus 20%. I said, okay, I'll pay you as per the stated provisions for settlement. I pay you 1,80,000. Next, the amount by which the contract is unfavorable from the perspective of the acquirer when compared with the market, current market. Now you start looking at that. If I would have given this franchisee right today, I would have given it 4,50,000, whereas the book value is supposed to be 150. So the amount by which the contract is unfavorable. So he would say, boss, it was unfavorable deal. Because now the book value is appearing to the extent of 150. And if you compare it with the current market terms, it would have been at 450. So what is the amount by which it is unfavorable is supposed to be 3 lakh. So you need to basically, in simple words, what you need to do in terms of the point number 1, you need to compare the current market value versus the book value and see what is the unfavorable amount. And in point number 2, you need to consider that what is the penalty you'll pay to terminate the contract. So whichever is less is going to be the amount of gain or loss to be recognized. So we're going to recognize a loss of 1,80,000, and then it says if 2 is less than 1, 2 is definitely less than 1, the difference is included as a part of the business combination. So that's why I said 450 is a reacquired rights in the net assets and the 180 on the credit side. So the difference indirectly 270 is a part of the business combination. So basically just understand one thing, that in this particular case, you are basically looking at the fact that there is a money paid on settlement, which is 180. So you need to put an entry profit and loss debit bank credit for the compensation paid to cancel. And at the same time, since it's a reacquired rights, you need to bring it into the books of accounts, which is at a fair value for the remaining period, which is 450. So what I give you a crux is that in the entry, you incorporate the net assets reacquired rights 450, and the purchase consideration includes something which is paid for settlement of the pre-existing relationship. So you pay that 180 as a penalty, reduce the PC to the extent of that 180. I guess you got a clarity. I know it may not be 100% at this moment. I know there is some still missing links which we need to consolidate, but let me see if there are any questions coming so far. Okay, I think so far so good. But in any case, I need to create a mind map to you, but I think I'll not create the mind map right now. We should, I think, first give you a small little break. I'm sure you need that, because today must have been a very, very technical day to begin with the complexities of the share-based payments and with the complexities of the pre-existing relationship. But trust me, the complex part is got over in terms of the step number 5. Step number 4. In terms of step 5, that is NCI or goodwill, it's not very complicated, though we'll do a little discussion, but it's not a very complicated affair. And then finally, we can do a consolidated question on that area as well. So I think at the first instance, let's give you some break. It's almost like 8:43, so 10 to 12 minutes break, friends, with you. And then we commence back. So relax your mind so far. I'll join you back, friends, after the break. Welcome back, friends. So I hope your mind got relaxed. I think let's consolidate the picture in terms of a pre-existing relationship. Let's make a mind map that what do we need to do in terms of a pre-existing relationship with the entry effects, etc. So let's take you back and just make a mind map on this area. So this is my 7th issue, which is on the purchase consideration. And let's document this with you. That is on the pre-existing relationship. So now we need to keep the thoughts very clear that when we're looking at a pre-existing relationship, you need to first of all focus that is it non-contractual or is it contractual in nature? So let's put it like this. So we've got the concept of pre-existing relationship. So when you're looking at the concept of a pre-existing relationship, we need to focus first of all that there are two permutation combinations. Either it is a non-contractual relationship, no contract basically, or it is supposed to be a contractual relationship. Now, the non-contractual relationship, typically, as the example is given, could be a lawsuit. And as I'm making a documentation in terms of the accounting, I am indirectly considering one direction. One direction in the sense that in terms of a lawsuit, the suit is filed by the acquiring company. I think the chart will become too complicated if I start taking two side directions that, a court case was filed by acquirer or the court case was filed by the acquiree. So in my chart, I'm taking a very basic presumption for convenience. So I'm giving you the chart on the assumption in terms of a non-contractual relationship that there is a court case which is filed by acquiree. It is a court case which is filed by acquiree against acquirer. So this is my presumption as I document this, that I'm assuming that there is a court case which is filed by the acquiring company on the acquirer company. So the acquirer had to pay something to settle the pre-existing relationship. It can be the other way around as well, but I'm just considering one direction. Okay, so in terms of a non-contractual relationship, I would say that in this particular case, what you need to do, you need to first of all pass an entry before acquisition accounting. So before we do the acquisition entry, so before that, you need to pass an entry in the books of accounts of the acquirer. So what is the entry which you're going to pass? The entry is you will make a debit to the provision if it is already there in the books. So you need to see that did the acquirer company already create in the books of acquirer. So you need to see that the acquirer had created any kind of provision for the court case or not. If yes, you can debit the amount of provision already there. And then you need to pay an amount which is equal to the fair value. And this would, of course, be given in the question. This will, of course, be given in the question. And then I will take a balancing figure, and the balancing figure is going to be a profit and loss, which will get a debit. So this is, you can say, the entry which you need to do. The first focus, that if there is a pre-existing relationship and you settle it. So this is the entry which is being done for the settlement of the pre-existing relationship. You need to make a debit for the provision to the extent there is already a provision in the books. The bank is going to be given a credit for the amount paid. The fair value is nothing, but it is the amount which you're going to pay. So the amount paid and the fair value is same. So you pay the amount equal to the fair value of that liability. So we will take a hit to the P&L as a balancing figure. This is one thing which we need to do. And then apart from this, what you need to do, when you put the acquisition entry, When you put the acquisition entry in this case and you take a credit to the PC, you need to reduce this amount of fair value. Remember, you need to reduce the fair value, not that balancing figure, because you need to reduce the purchase consideration with the amount paid. So in this particular case, you will reduce from the PC the fair value, or you can say the amount paid. So there are two focus points which you need to take care when there is a settlement of a pre-business combination. I'm again putting the point very clear that I'm giving you entry which is one-sided. One-sided in the sense that I'm working on the presumption that a court case is filed by the acquiree against the acquirer. It can be the other way around as well, but I don't want to make all the permutation combinations, because even the questions which are given are mainly based on the fact that a court case filed by the acquiree. So which means as an acquirer, I'll end up paying an amount, including the settlement amount. So we need to make a reduction of the amount paid for the settlement from the PC, and you need to put this entry before the acquisition date. I'm planning an exercise. I don't know whether I should do that or not, but if you want, I can do that. That in step number 7, I give you the broad entries, considering all the steps we have done. What entries are to be done pre-business combination, what entries are to be done on the acquisition date, and what entries need to be done a post-business combination. Do let me know if you want me to give you the combinations of entry pre-acquisition date, which means either a previously held interest is getting revalued or a pre-existing relationship is being settled, the entries on the acquisition dates, and then the entries in a post-business combination like unwinding of discount for a DC, fair valuation remeasurements for a CC, etc. Do let me know if you want to do that, because soon we're going to come to step number 7. I could do that exercise with you as well. So it all depends. If you want me to do that, you can ask me, I'll do that. If you don't ask me, I'll just give you the entry, one entry. Okay, then in terms of the contractual relationship, what we need to do, we need to be careful that this would give rise to two aspects. I can say it may give rise to, you can say reacquired rights. So in this particular case, it may give rise to what we can say reacquired rights. So in this particular case, it might give rise to what we can say the reacquired rights in this particular case. So when I say that there is going to be a contractual relationship in this particular case, there could be a situation that it could lead to a case of a reacquired rights. So when I say it could lead to reacquired rights, now see what we need to do in this case. Before the acquisition entry is done, so before the acquisition entry is done, you need to put an entry settlement figure. So you're going to put an entry profit and loss gets a debit and the bank gets a credit. So this is the amount which we are going to settle. So this is the entry with which the amount is going to be settled. Now, what is the amount of this entry is the crucial point. The amount of this entry is supposed to be, you can say, the lower of the two. It is supposed to be the lower of the two. And what is the lower of the two? One is the penalty paid to terminate. So one is the amount of penalty paid. One is the amount of penalty paid to terminate the contract. In the example which we did, the amount of penalty which we paid to terminate was 1,80,000. So you need to consider what is the penalty which you'll have to pay to terminate the contract. And number 2, you need to see the book value versus the market value and calculate the unfavorable amount. You need to compare the book value and the market value and get the unfavorable amount. I'll just condense the language to a simple part. You need to see what is the book value, 150 in the example, the market value, which is 450 in the example, compare the two and get the unfavorable amount. So the penalty, which is 150, or the unfavorable amount 3 lakhs, whichever is less, we're going to put this entry with this amount, P&L and bank. Generally, to my mind, the amount one penalty will always be a lesser amount. That's what I logically feel. And then on the acquisition accounting, then when you do the acquisition entry, what you need to do, you need to take care of two important aspects. In the acquisition entry, when you consider the net assets debit, this should be now including, this should be the amount including the reacquired rights. You need to include this reacquired rights as a part of the list. Now, since it may give rise to reacquired rights, so when you do this acquisition entry, you need to insert that reacquired rights as a part of the list. And when you consider the PC on the credit side, you need to reduce the PC by the above amount which you've calculated. So whichever is the lower of the two, you're going to reduce that amount. So one entry is done to settle the pre-existing relationship. Then as a part of the net assets, you insert the reacquired rights. In the given example, 4,50,000, and you also need to make a reduction of the PC to the extent of the entry with which this P&L to bank is done. So this is the crux in terms of the pre-existing relationship. And this also takes care of my step number 4 in terms of the purchase consideration. DC, CCE, CCS, TC, PHI, SBP, pre-existing relationship, everything is done. Okay, so this is one bit. And I guess Rahul tells me, yes, do all the entry. Just one request that, people tell me to do all the entries. I think none of the other people want it. My hard work, just only one person wants it? No. Okay, so I think we'll decide on that. We'll decide, if majority wants it, then we give you that 7th step. Anyway, so this is done. Now we are going to go to the next step. So now the step number 5 is about NCI. And the step number 6 is about goodwill. So let me quickly give you the step number 5 and 6. No complications much on step 5 and 6. So let's now give you the next step as a part of the acquisition accounting, and that is step number 5, which is calculating an NCI. Now, there is one crucial point, of course, which I like to make at this stage, because the calculation of the NCI will definitely impact the amount of goodwill. And in this case, I would like to give you the inputs regarding the concept of a full and a partial goodwill. I don't know if you've covered Ind AS 36 so far, where the impairment testing depends upon the goodwill is partial or full, but I'm not getting to the impairment aspects. I will only give you the inputs with regard to, the goodwill is going to be full or partial, whatever the case might be. So watch this carefully. If you look at Ind AS 103, the companies have got a choice, an option to calculate NCI in 2 different manners. The standard gives a complete choice to the acquirer that you can calculate the NCI either at a fair value. This is one option. Or you could calculate this at what we call PASNA, that is called a proportionate. That is called a proportionate share. That is called a proportionate share in net assets. That is called a proportionate share in the net assets of the acquirer. So the acquirer company has got a complete choice. Either he can choose to record the NCI at a fair value, or he could consider the NCI at a PASNA. It's a pure choice. The question will give you the clear-cut instructions that NCI is to be taken at which value. So you don't need to bother yourself. The question will tell you whether it's taken at a fair value or whether it's taken at a proportionate share. Now, if you say that we are going to take the NCI at a fair value, what I need to do, I will take the number of shares held by NCI. I will take the number of shares which is held by the NCI and multiply this with the fair value per share of acquiring company. So I will multiply this with the fair value per share of the acquiring company, simple and straight. So let's say 1,000 shares are there in the acquiring company. 800 is held with the acquirer, so 200 shares are held by the NCI. So what I'll do, I'll just multiply the 200 shares into the fair value per share and get the amount of NCI. Simple and straight. The fair value per share would also be given, and you easily know what is the number of shares. The alternative number 2 is that in this particular case, you can take the net assets which you calculated in step number 3, which you calculated in step number 3B to be precise. So you're going to consider the net assets, what you took in step number 3B, and multiply this with the percentage which is held by NCI. So let's say 20% is held by the NCI. So you would take 20% of the net assets computed in step 3B. So you know what is the net assets in step 3B, just multiply the net assets with the percentage held by NCI. That's it. So this is the 2 alternatives which is available, and the question is going to give you a clear-cut instruction that what do we need to follow in this case. So I don't see any challenge in terms of calculating the NCI. Then comes the next step, that is the step number 6. In terms of step number 6, we need to calculate a goodwill, or what we call a BPG, that's called a bargain purchase gain. That's called a bargain purchase gain, as good as a capital reserve. So you can call this as good as a capital reserve. So we will calculate a goodwill or a bargain purchase gain, which is nothing but a capital reserve. So this is again a simple mathematical calculation that you need to consider the purchase consideration, which you've already taken in step number 4. So you have the purchase consideration in step number 4, which represents, let's say, an 80% stake acquired. And to this, you add the NCI, which you've just computed in step number 5, depending upon its fair value or depending upon it is at PASNA. So indirectly, when you add this, it's like 80 plus 20, you get a sum total, which is 100%. And when you compare this with the net assets, which you've already computed in step number 3B, which is 100% net assets, and we're going to get the balance as a goodwill or a capital reserve. So you can say that if this is, let's say, A, and let's say this is B, you get A plus B, and let's say this is C. So we can say if A plus B is greater compared to C, you're going to get goodwill. And if it is less, you're going to get a capital reserve. It's as simple as that. So there is hardly any inputs to be discussed on that front. So we can say that when you're looking at the goodwill calculations, you just need to do a simple mathematical calculation. The amount of consideration which you paid, including the PHI, because this PC is already including the PHI. We did this in the business model, business test as well. So when you take this PC and add the NCI, you get a 100% figure. You compare it with the 100% net assets. If the PC NCI is greater compared to the net assets, the difference is goodwill. Otherwise, it is going to be capital reserve. Now, the only thing which I need to tell you at this stage, whose impact you'll see in terms of impairment is, if you consider the NCI at a fair value, we are going to get a goodwill which is called a full goodwill. And when you're going to consider the NCI at PASNA, you're going to get a goodwill which is called a partial goodwill. So why? So why is it called a full or partial goodwill? I guess, friends, I'll explain that when I come to Ind AS 110. Don't worry, it's pending, but we'll discuss that and explain you why is it a full or partial goodwill. I don't think so it is the right time to discuss that at this stage, because unless you understand the consolidation technique, I can't explain that. So don't worry, I will be coming back to this area once again with you, explaining you that if you take an NCI at a fair value, why is it called a full goodwill? And if you take NCI at a PASNA, then it's a partial. Why? Don't worry on the logic. That would be discussed when I come to Ind AS 110. Explain you the consolidation techniques, then I'll tell you the logic, because without understanding consolidation, we can't really appreciate at this stage. So just that be a nomenclature for now. that if NCI is at fair value, it implies goodwill is full. And if NCI is at PASNA, it implies goodwill is supposed to be partial. Logic pending. Right. So this is step number 5, and this is step number 6, which is more or less, you can say, a simple mathematical exercise. That's it. Okay. Now we come to the step number 7 with you. And I guess we got another input from Koshki. Yes, sir, please give the entry. Okay. So I think 2 people want me to give the entries. So I think we'll definitely give you the entries now on step number 7. So let's give you now the step number 7, which is going to give you a consolidation of things. Now, before I give you the entry, let's get one thing very clear. We are done with step 1, accounting acquirer. We're done with step 2, acquisition date. We're done with step 3, A and B, Ind AS 12 and a list of net assets. And in step number 3B, we've done now the share-based payment. We're also done with the reacquired rights, which was pending. We're done with the step number 4, PC with 7 issues. We're done the step number 5, NCI. We're done the step number 6, that is goodwill. Now the step number 7 is nothing but based on all these things. So when you're going to put the entries in a bigger question, let's have a macro view in terms of the entries, which will be pre-acquisition date and post-business combination. Let's begin the journey. So this is going to be a comprehensive list of entries. So if you get a very complicated kind of question, like there is one particular question which is there in RTP, I may not take up that question in the class because the time may not permit, because doing that question is almost like a 1.5 hour exercise. And it's got too many components to handle. And I think we've got a limited time to do things. So I'm not going to do that question. It's there, in the RTPs. You can definitely try that. It's a very good question which contains a blend of things on step number 3B. Then there is one particular question which again came in the RTP. I'll show you that question. I'll tell you today which question you can practice in terms of step number 3A, Ind AS 12, and in terms of step number 3B, which is going to give you a very good practice in terms of step 3. Okay. So now let's get on to the step number 7. And in terms of step number 7, my focus is on the journal entry. Now see this very carefully. This will also give you a quick recap of the kind of entries, the concepts we have already covered. So get ready for the journey. So let me do one thing. Let me create an entry in a total of 3 blocks with you. So I'm looking at I'm looking at acquisition date, and I'm looking at post. So let's consider the entries in 3 blocks. So I'm looking at the entries before acquisition entry. I'm looking at the entries which is immediately before acquisition entry. Then I'm looking at the acquisition date, basically the acquisition accounting entry. The acquisition accounting entry, and I'm looking at entries which relates to a post-business combination. Now, watch this carefully. Basically people know about this entry, but they tend to forget what is the entry here, and they tend to forget what is the entry out here. So let's give you a comparative position of all things put together. Now, if you remember, just go through the steps in mind. Step number 1 and 2 doesn't contain entry. It's identifying acquirer and the acquisition date. So the focus is in terms of step number 3, which is like getting a list of net assets, which is for this purpose. The main focus is when you focus on the entries immediately before acquisition date, you need to focus on step number 4, because that's where the entries related to before acquisition is given. DC, no, it's going to happen here. CC is going to happen here. TC is again going to happen here. And the entry is step acquisition, yes. Pre-business, pre-existing relationship, yes. So there are 2 aspects which we need to consider. So I can say if there is a PHI, previously held interest, you need to put an entry. So we knew that there are 2 cases. If it is a conversion from a passive investor into a controlled situation, then we know that we are putting a journal entry, and that is, let's say investments went up. So investments will be given a debit, and the P&L or the OCI gets a credit as the case may be. As the case may be. Because if you remember, as per Ind AS 109, you might be recording the investment at FPTPL, or you may be recording the investment at FPT OCI. So you need to remember that a revaluation gain or loss is going to be taken in the P&L or OCI. And in this particular case, you also need to keep a track that any accumulated OCI balance needs to be transferred to retained earnings. That needs to be transferred to the retained earning. So you need to remember that this is an entry to be done if there is a PHI. This is maybe a passive to control. The other permutation combination could be a significant influence to a case of control. It could be a case of a significant influence to the case of control. And in this particular case, there are two entries to be done. If you recall, the first entry is when you revalue the investment gets a debit and the profit and loss gets a credit. So this is basically the revaluation gain, which is going to be taken always to the P&L. And along with this, you need to scrutinize the balance in the OCI. You need to scrutinize what is the balance in the OCI, and you need to put the amount in the P&L or the retained earnings. If the amount relates to recycling, you're going to put it in the P&L. If the amount relates to no recycling, you're going to put it in the retained earnings. Get this very clear, that if it is a passive to control, there is one entry. If it is supposed to be significant influence to control, there are two entries to be done: revaluation of the investment and the putting the OCI balance in P&L as well as retained earnings. This is one. Let's take it further. Let's take it further. And I guess if I continue my chart, in this particular case on before the acquisition date, so we can say the other focus entry is regarding the pre-existing relationship. It is regarding the settlement of pre-existing relationship. So if there is a pre-existing relationship and it is being settled, so that is another area which you need to watch out. So you can see that there are two focus areas. One is the concept that if there is a concept of a PHI, these entry needs to be done before that main acquisition entry. And another focus is on the pre-existing relationship, which depends upon is it non-contractual in relation, which depends upon it is non-contractual in area, or it depends upon that it is contractual in nature. So in this particular case, the key focus points, because this is going to help you in the larger question. So when you're looking at a non-contractual relationship in this case, then the entry is provision gets a debit if there is any, and the profit and loss gets a debit, which is the balancing figure, and the amount paid, which is the fair value, or you can say the amount paid is taken on the credit side. So this is the entry which you do for a settlement of a non-contractual relationship. And then if it is a contractual relationship, you got to put the entry profit and loss will get a debit and the bank gets a credit. And this entry is done, if you remember, with the lower of the two. So the two figures I've already given you, you can refer the notes earlier and put that part out here, that what is the lower of the two. Just to remind you, the amount of penalty or the amount it is unfavorable compared to the market terms, whichever is less. So this is the entry which is done for the settlement of a contractual relationship. So watch out, that is the pre-existing relationship contractual or non-contractual in relationship, and accordingly do this entry. Okay, so these are the only two focus points to be considered at the before passing the acquisition entry. Then comes the acquisition entry, and when you look at the acquisition entry, it is net assets given a debit. Now, when you consider the net assets as a debit, you're going to pick up things from the step number 3B. You're going to pick up things from the step number 3B, but there is more inputs to be seen. You need to see that if there is any reacquired rights as well, because we never took that as a part of the step number 3B. So you need to see that there are any reacquired rights arising out of contractual pre-existing relationship. So arising out of pre-existing contractual relationship, which you will be able to identify when you've been working on step number 4. That's crucial. So when you've been working on step number 4, just be careful that in the net assets, you never took that reacquired rights because we kept it pending. So if there is any reacquired rights as well, you need to consider that. Let's put that out here as well, which you were done and kept in mind when you were in step number 4. And then next you consider the purchase consideration, which is based on the step number 4. Then you've got NCI, which is based on the step number 5. And let me also tell you that we'll spread this PC as well. And then you take a balancing figure goodwill, which is based on the step number 6. Okay, I'm considering that this PC is including that SBP reserve as well. So I'm inserted all that. So this is the entry which you do on the acquisition. So the only focus point which you need to be careful when you're passing this entry is this part. This is something which we tend to miss at times. So you need to get this clear that the reacquired rights is to be seen. Then I would suggest now you need to look at the discharge of the purchase consideration. Because you've taken the purchase consideration, now you need to consider the discharge entry as well. Now watch this carefully. When you look at a discharge of the PC, so in this case, there are two elements to be taken care. One is a PHI. The PHI is the previous investment which you had is to be credited. So this is the investment which will be cancelled at this stage, which is PHI. Since the PC is including the PHI, so you're going to give a credit to the investment in the second entry. And then you're also going to record an SBP reserve. And this is something which you would have taken care in the PC while calculating the step number 4. So these are the two crucial points which you need to consider very well, that you need to credit an investment for the PHI and you need to give a credit to the SBP reserve at this stage. So mind it, very important indeed. And then the purchase consideration might be discharged by way of equity shares, maybe issued at a premium, or maybe a cash component is given, or maybe there is a deferred consideration, or maybe there is a contingent consideration as well. So when you put this entry, be careful that the PC is comprising of the PHI, the SBP reserve, the payment in the form of shares, and the payment in the form of cash. Then there is a DC and a CC, which is to be presented in the balance sheet. This will be as a financial liability, or this would be as a financial liability or equity instruments. So that becomes a discharge. Interesting. So which means that this is like a takeover entry. And this is like the entry for the discharge of the consideration. I'm just going to giving you a comprehensive view. Right. So this is in terms of the acquisition date entry. Then further, if you look at the post-business combination, I think the only concern is in terms of three things: unwinding for a DC, remeasurement for a CC, and Ind AS 102 share-based payment to be accounted for. So there are three focus points. Number one, the first focus point would be in terms of that there is an unwinding of discount related to DC. So you put the entry finance charge gets a debit and the DC gets a credit. This is the unwinding of discount. The second focus is that there is a remeasurement. There is a remeasurement of CC. So there is a remeasurement of contingent consideration classified as a financial liability. So maybe if it is a loss P&L debit and contingent consideration gets a credit, vice versa, whatever the case might be. So, or vice versa, there might be a gain or there might be a loss, whatever the case might be. And typically the third aspect which you need to take care is that there might be a share-based payment which is to be accounted as per Ind AS 102. So the portion which relates to the future services is going to be taken care of separately. Imagine if somebody will make a most complicated question on things, it can be a wonderful treat to watch in terms of Ind AS 103. So I've given you a complete picture of all the possible kind of entries, more or less, which could arise in terms of step number 7. From the entries to be done before acquisition entry, entry on the acquisition, and what are the entries on a post-business combination. I hope this helps you a lot. Okay, so far so good. And I guess I am getting a few questions. Which RTP? I'll just give you that RTP, of course. And Jay, you said, sir, pre-business combination SBP replacement award is always a part of NCI as acquisition is taking place afterwards. No. In a mandatory replacement, it is not a part of the NCI. It is only if there is no replacement, then it is a part of NCI. So you can say the pre-business combination is going to be treated dependent upon if there is mandatory, not NCI, SBP reserve. And if it is no replacement, then it is a part of NCI. Because if you're making a replacement, then it is not going to the NCI, it's going to be in your books. And if you're not going to make a replacement, then it becomes a part of the other outsiders, that is NCI, right? Okay, so I think I'll tell you now which questions you can practice. I'll take a small question for practice right away with you, but I'll tell you, I put that question in the assignment as well. You must try that question. I'll tell you the RTP. Okay, I'll tell you which question you can do. I think one of the good questions which is there, and that is MTP August 2018. So I would say that one of the questions you should definitely try out. So you should try the one is the RTP question. I'll let you know. You must try the MTP August 18. I'll share this question to you in the assignment. So you must do that. This is the question number 36 in the assignment. And the other question, which is a very good question indeed, and that is question number 39. That is a question number 39. It's RTP November 19. It's RTP November 19. So you can do RTP November 19 question. It is question number 39 in the assignment. I'll share these questions to you today in the handout. So try these questions, very brilliant question. This question has got a major focus in terms of step number 3A. It has got a major focus in terms of Ind AS 12. It'll give you a good practice on the step number 3A. And this question has got a very good blend in terms of the step number 3B. So on the list of the net assets, a couple of exceptions are given. So you'll see a lot of flavor of exceptions coming in this particular case. So try these two questions. You're going to get a good flavor of things. Very good questions, I think, on a business combination part. Okay. So now I think let's do a question with you. Time is still running. So I think let's now, since we've done all the steps, let's do a small little question with you. Not a very complicated one, but let's take one question with you. Then we are left with reverse acquisitions, and we are left with, then we're left with the concept of common control. So I think let's take you to a simple question, which is also in the study material as well. So let me do one thing. Maybe we can also do an examination questions on the same line. Let's go to the study material question. So I'm looking at question number 34. This is a question in the study mat. So let's do this question with you. And trust me, as I read this question, to my mind, you should understand every word in this question, because you spent a good time understanding the 7 steps. You should now understand the question, and it should be a cakewalk. Let's, I think, read the question with you, and then we'll solve it. So question number 34, I am given the insight. Let me just first give a reading to you. So question number 34, we are given. It says company A and B are in a power business, and A has got a 25% equity shares already. So that means it is a PHI, and that means a significant influence. Aha. So my mind is telling me that there are two entries to be done before the acquisition entry. One is the revaluation of this PHI, and then to see that what is the balance in the OCI to be taken to retained earnings and P&L. On 1st November, the company A obtains a control when it further acquires 65% stake. So 25 plus 65 means 90. So there is an NCI to the extent of 10%. Then he says, resulting in a holding of 90%, the acquisition had the following features. He gives you about the purchase consideration, that there is a cash payment, and there is issue of 1 lakh shares, and the market price of the shares on the date of issue is 10 rupee per share. I can see the cash component is 59 lakhs and the share is 1 lakh rupees of 10 each. Primarily the consideration seems to be in cash. And if primarily the consideration seems to be in cash, then the company paying the cash becomes the accounting acquirer. The equity shares, as per this transaction very clearly given, comprises 5% of the post-acquisition equity of A. So he also tells you in terms of percentage, when A gives the shares to the shareholders of B, their shareholding is 5%, which means A continues with a 95% shares in the company. So he still retained a control, which again proves that it is not a reverse acquisition. Then contingent consideration says A agrees to pay an additional consideration, and it says ifs and buts. If the cumulative profits of the company exceeded 70 lakh over the next 2 years, and at the acquisition date, it is not considered probable that extra consideration will be paid, the fair value of this contingent consideration is already given. So the conditions are not related to service. So one thing is pretty clear, that if there are no service condition, then it is supposed to be CCS. That means it is paid in the shareholder's capacity. Then I'm given the TC, that there is a transaction cost, which is revenue in nature. By the way, you can add an entry in step 7, profit and loss debit bank credit for the TC. You can do that. Then he says there is an NCI, and the fair value of the NCI is already given, which is give us a full goodwill. And it says company A elects to record this at a fair value. So we're already given that what is the value of the NCI as well. And then further information on the PHI is also given. A has got 25% stake, which was taken several years back. Investment is included in the consolidated balance sheet at 6 lakh using equity method, because it was a significant influence, and the fair value today is 20 lakhs. The fair value of the net assets is also given. So list number 3B is already given. Determine the accounting under acquisition method. A similar kind of question came for 8 marks in the exams. That is question number 35 in November, I guess 2019, I'm forgetting. So that was an examination question. I think let's do this question with you. It's in the study material as well. So let me just do this question with you. So question number 34. Let's, I think, apply the 7-step model. So we're looking at the answer to question number 34, and we're going to go systematically on the 7 steps. Trust me, if you know the criticalities which are to be applied, it's not a big deal. So we start with the step number 1. And in this case, we need to identify the accounting acquirer. So the step number 1 is that we need to identify the accounting acquirers. So please keep the question in front of you, and we're going to work upon this. So in this particular case, We are given the inputs in terms of accounting acquirer, that in this case, let me just come back to the names of the company. It's company A and B. So we can tell the examiner two things. We can say, number one, the purchase consideration is primarily in cash. So we can tell the examiner, number one, that the purchase consideration is primarily in cash, which supports that it's not a reverse acquisition. And number two, we are given that post-business combination, shareholders of B, post-business combination, shareholders of B will have a 5% stake, in B, stake in company A. So I think both these factors very clearly tells me that the accounting acquirer is company A. So it very clearly tells me that the accounting acquirer is supposed to be company A. So give the reasoning to the examiner that the consideration is primarily paid in cash, and the instructions that B shareholders will get a 5% stake. So A continues with a 95% stake. That is, A shareholders have 95% stake in the company, which supports the fact that it's not a reverse acquisition. It gives a clarity on your part to the examiner. Then you go to the step number 2, and in terms of the step number 2, you look at the date of acquisition. And I think in this case, we're not given any inputs on any closing dates, etc. So I think we're very clear that the date of acquisition is 1st November. So this is very clear that 1st November is the date of acquisition. Pretty simple and straight. Are we given a tax rate in the question? No. So if there is no tax rate, we are saved the trouble of step number 3A. So we go to the step number 3A, and you can, of course, give the details to the examiner that the tax rate is not given. Since the tax rate is not given in the question, so we can comfortably say in this particular case, no, Ind AS 12, there is no application of Ind AS 12. We don't need to apply the standard. Okay, then you go to the step number 3B, and in terms of step 3B, you look at the list of net assets. Now, this is a very safe question where if you look at any exceptions are contained in this particular list or not, I think there are no exceptions. I'm not given any contingent liability, any indemnifications, any share-based payments, etc., no reacquired rights. So I think the net assets is very fairly given to me. And I am clearly given the net assets is supposed to be 60 lakhs. So we are given the figure of 60 lakhs in the question. So it is directly given in the question itself. No complications at all. And then you go to the step number 4. And in terms of the step number 4, you need to calculate a purchase consideration. Now, when you're calculating the purchase consideration, I would say get your checklist on the 7 items and then calculate a PC. So as a base, you are giving cash and you are issuing equity shares. So you need to definitely consider the cash and the equity share as a base, and then consider the list of 7 items. I think the quantum of cash given is 59 lakhs. And the company is issuing 1 lakh shares with a fair value of 10. So the equity shares issued is worth 10 lakh. Then get your checklist in terms of the special issues. Just in case, to get the clarity of thought, let's see if there is a DC, if there is a CCS, if there is a CCE, if there is a TC, if there is a PHI, if there is an SBP, and if there is a pre-existing relationship. Get the checklist so that it becomes easy to calculate a purchase consideration. Trust me, the moment you've got a clarity of thought, the questions would be a cakewalk. So in terms of DC, I think there is no DC in the question. Then I think contingent consideration was there. we were given the contingent consideration, and the contingent consideration we said was CCS. The fair value of this was 3 lakhs. So in this particular case, the amount of contingent is 3 lakh. CCE and TC as it is not taken. Then the previously held interest, we need a fair value. And we are given the fair value of the investment is 20 lakhs. So we are given the figure to be 20 lakhs. So PHI is 20 lakh, no share-based payments, no pre-existing relationship as well. 59 plus 10 plus 3 plus 20, let's get the purchase consideration. So that makes it 69 plus 23, that's a total of 92 lakhs. I think if you're feeling very comfortable doing this particular question, that's a good sign. But if you're facing trouble in terms of doing this question, it's a bad sign. Because I think to the extent of the complexities we have discussed, this question doesn't contain any kind of complexities. Okay, so this is step number 4. Now let's go to the step number 5. So let's add on to the step number 5. And in terms of step number 5, we are looking at NCI, and I think that's already given in the question. The NCI is being taken at a fair value already given in the question. Let's see. So NCI is given to me at a fair value. This is 7,50,000. So the NCI is supposed to be 7,50,000. That is the NCI given. Then we go to the step number 6, and we need to calculate the amount of goodwill or a bargain purchase gain. And in order to calculate this, you've got a mathematical calculations to do. So in terms of the mathematical calculations, we take the PC and add the NCI and then compare it with the net assets. And you're going to get the goodwill or the capital reserve, that is bargain purchase gain, whatever. I'm doing this question with a little speed. You can understand the reason why it's so simple. So I'm on a little speed to do this question. I hope you don't mind. So the purchase consideration is 92 lakhs and the NCI was how much? The NCI is, I think, 750. Oh, sorry, it was already given above. So I don't need to watch it out. It was there. 7.5 lakhs is the NCI. So that becomes 99.5. And the net assets, I guess, was 60 lakhs. So we get a goodwill as a difference. 39.5 lakhs is the amount of goodwill in this case. Wow. So now I think we can look at the entries to be done in terms of the step number 7. So in terms of the step number 7, let's see the journal entry. So we're going to look at the journal entries in 2 parts. So we're going to look at the journal entries before acquisition date, and we're going to look at the entry which pertains to the acquisition accounting. So before we do the acquisition accounting, let's see the entry. Can I see in this particular case, the entry in this case is going to be, you need to first of all focus on number 1. That is, we need to focus on, is there a PHI? Yes. But I'm not given any accumulated balances of OCI. I don't know that during equity method, the question doesn't give me a status that what was the amount in OCI. So we'll just put one entry. That is, investment is to be revalued. So investment debit and the profit and loss gets a credit. So let's see what was the book value of the investment. In the balance sheet, it is appearing at 6 lakhs, but the fair value is 20 lakhs. So this is an increase of 14 lakhs. So we are considering the fair value 20 versus the book value that is 6. So this is the revaluation of the investment. No pre-existing relationship is given. That means I'm ready to pass the entry on the date of acquisition. Net assets gets a debit. The purchase consideration gets a credit. The NCI gets a credit. The net assets is 60 lakhs. The purchase consideration is 99.5 lakhs. And the NCI is supposed to be 7.5 lakhs. And you get the goodwill, which is also computed 39.5 lakhs. Sorry, PC was 92, I'm afraid, not 99.5. The purchase consideration is 92 lakhs. So that becomes an entry for the acquisition accounting, net assets, PC, NCI, goodwill balancing figure. Then you discharge the PC. And this is going to be PC gets a debit, that is 92. Cancel the investment, which is the PHI, that is to the extent of 20 lakhs. Make a payment of cash, that is 59 lakhs. And you've also got equity share capital. And I think the face value is not given. I assume that the fair value and the face value both are 10 lakh. So I think this is 69 and 10. And then there was a contingent consideration. And what was the amount of contingent consideration? Let's take the balancing figure. So 92 minus 79 minus 10, it was 3 lakh. So this becomes the entry for the discharge of the consideration as well. So the entries pre-acquisition date done, date of acquisition done, and the discharge entry done. No entries as far as a post-business combination is concerned. So that was a very simple question indeed to give you a flavor of the 7 steps on acquisition accounting. But Ind AS 103 doesn't get completed at this stage. We are done with a major chunk of the standard, but there are 2 more agendas which we need to cover in the standard. One is a case of reverse acquisition, and one is a case of a common control transactions with you. Let me in the meantime see if there are any questions coming in. Okay, so far so good. Okay, so now I'm just going to quickly do a little consolidation, but I'm not going to start with reverse acquisition right now, considering that we just left with almost like 5 minutes. It's not a good idea to take things. But now, one first sincere request to all of you. You need to do a consolidated revision of all the 4 classes we have done on Ind AS 103, because you could see that we were making a walkthrough in terms of the 7 steps, and we did a deep understanding of each and every step in between. But, since we don't have too much time, and therefore, if I had the liberty of that extra time, I would have actually done a more number of questions with you, those RTPs and MTP August, because when you do the larger questions, then you connect with those provisions very well. So, but I guess considering the time frame, so I may not be able to do those questions with you, but you need to practice those questions. And so basically what you need to do in this particular case is do a cumulative revisions of all the 4 classes put together. Go through each and every step very carefully, see the nitty-gritties. Like, for example, if you look at step number 1, your mind should run through the crux in terms of step 1. You should be able to identify what are the focus points in step 1, new entity created or not, consideration in what form. When you go to step number 2, you need to understand the focus. And especially when you come to step number 3, A and B, you need to be very clear that I need to get an Ind AS 12 application. You need to be very clear on step number 3B that, okay, these are certain exceptions. Watch out in the questions, the list of 8 items which we said. Recognition, measurements, and both the exceptions, but typically you will see indemnification assets, contingent liability, and share-based payment gets taken later, reacquired rights gets taken later, or maybe an NCA held for sale or employee benefit kind of assets and liability. So watch out for those exceptions when you do a larger question. Then step 4, you already have a list of 7 special agendas with you. When you calculate a purchase consideration, you should be very clear in terms of what are the crucial points in those 7 issues. So typically when it comes to a PHI, you need to be very clear of what kind of entries are to be done. If it is a passive to control or a significant influence to control. For SBP, you need to remember that there are 3 combinations: mandatory, optional, and no replacement. And for a pre-existing relationship, contractual, non-contractual, how do you calculate the gain or loss in terms of settlements? And step number 5 and 6 is not a big challenge, but you just need to know that, okay, NCI taken at a fair value, then the goodwill is full. NCI taken at a persona, then the goodwill is supposed to be partial in nature. And then I give you the step number 7, which was a consolidation of all the permutation combination of entries, looking into the entries done before acquisition, then on acquisition, and then a post combination. So getting the clarity that, okay, what kind of entries will trigger in a pre and what kind of entries will trigger when it is supposed to be a post combination. And then you practice the larger questions. Trust me, you're going to get a good hold on things. Okay, so on that note, friends, I think we are done for the day. And Koski, we have focused on PC primarily in cash equity shares. Why don't we see hybrid considerations as well? Well, from the examination point of view, it could be quite challenging indeed. So you would see that in the examination, of course, they can't test you too much on judgmental levels, because the standard gives you guidance that it is primarily in cash, primarily in terms of ordinary share. So I think that could be a bit challenging from the examination point of view. You're going to see a lot of variety when you come to the practical arena, right? Right, friends. So I think on that note, I think we call it a day. So I'm going to join you back on Tuesday with the reverse acquisition and the common control transactions. So enjoy your weekend, but study hard, consolidate and learn, just revise everything together. So time to bid you goodbye, friends, on that. Thank you, take care, and bye-bye.